Hey guys, just a quick video for you today. Something we're going to be doing at the end of every month is have a look back over the previous 30 days and see what the main market events were over those 30 days and how they've shaped the markets, and if we can learn anything about what the market's going to look like going forward as a result. And September has been a particularly interesting month. We're going to hit a few beats. First and foremost is going to be the NFP that came through on September the 6th. Then there was the ECB rate decision on the 12th September, closely followed by the Federal Reserve's interest rate decision on the 18th September. Then we're going to have a brief chat about the UK interest rate decision, the Bank of England. That was on the 19th. And then finally, we're going to talk about the Chinese stimulus that was announced at the end of the month and maybe have a little look at the current conflict in the Middle East. So stay with me. Won't take long. We're just going to go through it and we'll maybe learn some lessons about what the markets are going to do in October as well. So to start the month, we had the US non-farm payroll on the 6th of September. And all the data at this point, and for the previous month, and for months previous to that, people have been poring over, is trying to get some idea of what rate cut the Federal Reserve was going to push through on the 18th September. At this point, at the 6th of September, futures traders were pretty much split 50-50 on whether the Federal Reserve was going to cut by 25 basis points or cut by 50 basis points. The NFP came through on the 6th of September, a little bit weak, but not hugely so. It was 142K versus 160. And this wasn't enough really to move the needle too much. On the 12th of September, we actually had inflation data come through from the United States showing that inflation was holding about steady. And this is where we really begin to see a lot of change. And we saw that futures traders had decided that the Federal Reserve was only going to cut by 25 basis points. We know now they're wrong, of course, but very interesting to think about that and how quickly markets can change. So they decided that the Federal Reserve was only going to cut by 25 basis points. This gave the, and then obviously on the 12th of September as well, we had the ECB rate decision as well, where the ECB lowered rates by 0.25%. This gave the euro a boost. As we rolled into the coming days, it became clearer and clearer, and this is quite interesting, actually. We started seeing reports from major news agencies, financial news agencies like the Financial Times, Bloomberg, the Wall Street Journal, that actually the Federal Reserve was seriously considering a 50 basis point cut. And this feels to me like it was probably leaked to these journalists. That the Federal Reserve, I don't think, wanted to catch the markets wrong-footed. The markets had decided there was going to be 25 basis points, and they wanted to make it very clear that the 50 basis point was their preferred option. So we saw very quickly the turnaround in the probabilities for this. So by the 18th of September, the markets were well prepared. We saw a 50 basis point cut. And this obviously had a huge impact on the markets throughout. And it's quite unusual, the 50 basis point cut, because this is only usually used in times of extreme distress, when markets panicking, when central banks panicking. But this time it seemed to be used quite clearly as a lever, as a tool. The Federal Reserve was stating that they're content with inflation where it is now. It is still slowly falling, but that they wanted to make sure that the labor market remained strong and that the US economy remained strong. So really the messaging around it was the difference. And that was very interesting to see that. It's the first time we've seen that. So as a result of this, we saw a US dollar weakness feeding through the markets. It's actually at this point, next day, especially interesting, is the Bank of England on the 19th September decided to keep interest rates on hold. And of those three big central banks, the Federal Reserve in the United States, the ECB in the European Union, and the Bank of England in the United Kingdom, they were the only ones to hold interest rates steady. The UK is facing its own issues, obviously, and there seemed to be some disagreement between the committee who decided on these interest rates. But still, the final result was a hold, and this gave a huge strength to the pound. Anybody who's seen the pound to the USD, the GBP to the USD, will see that the pound has strengthened considerably around this time. And we saw the DXY, which is obviously the US dollar index against a basket of currencies, we saw it begin to slide as a result of this 50 basis point cut. This pattern continued until, and then we saw very interestingly, not so much for the FX markets, but for global markets in general, the Chinese, after years of economic, not decline so much, but economic malaise. On the 24th of September, the central bank in China announced a huge stimulus package for equity markets in particular. This was backed up 2 days later by the Politburo, led by President Xi Jinping, announcing that it's not just going to be for equity markets, but they're going to be looking at property markets. They're going to be looking at ways of propping up, of boosting the entire Chinese economy. Now, you would have thought this did give a boost to emerging market currencies. We've seen especially the rand having its best, the South African rand having its best month against the dollar for quite some time. And this is true across the board. This is because anything that's good for China is good for emerging markets. And, off the back of dollar weakness and then this China stimulus on top of it. So we saw the DXY continue to fall. We saw the USD performing weakly, performing quite poorly against most currencies, except the euro, of course, because the Eurozone is in its own economic troubles. We're looking at probably a recession in most places, and still consumer weakness is very poor. Euro USD aside, we did see USD losing ground across most of the month after the 18th of September. But then we get to the end of the month, and this is where everything's changed. And the beginning of October, we've seen the conflict in the Middle East really ratchet up. Israel, as I'm speaking now, has invaded southern Lebanon. Iran has fired a barrage of missiles at Israel and is threatening more. Israel is threatening a response. And the markets, as you would expect, have gone straight into risk-off mode. The DXY and the USD against most other major pairs have spiked as people move into the safe haven dollar. Gold prices have gone through the roof and oil prices have gone up as well. And I think this is obviously a reaction directly to geopolitical events. It's not something that can be predicted, though anybody who's been watching the Middle East conflict for the last few months could see that this is probably going to happen at some point. And this, I think, is probably going to shape markets going forward. So as much as, the previous month was shaped by the Federal Reserve's interest rate decision, I think October is going to be shaped by events in the Middle East, which unfortunately are incredibly unpredictable. And hence why I think we're probably going to see continued support for the US dollar. We're probably going to see continued support for gold prices, and oil prices are probably going to continue to rise. If we see a calming in events in the Middle East, then I think we'll probably the next thing to look at is going to be the US election. And hopefully we do see a calming in the Middle East, because it's not just this is not just obviously an issue for markets, but it's an issue for the wider world as well. So let's hope for calmer, cooler heads in the Middle East and calmer, cooler markets as a result, so that we can actually get back and looking at more normal events like the US presidential election, interest rates and inflation, CPI data. Thank you so much for tuning in. We'll be back again the end of next month for another quick look over October's markets. Thanks so much.